Welcome to this presentation on the emerging economic and market scenario. As I speak to you on the 14th of June 2016, globally the stock markets are volatile. In India also the market is very volatile. The market has been oscillating between hope and fear for some time now. We feel that in the coming days, the market will continue to be volatile due to some global developments. There will be dips in the markets. And these dips in the market, we feel, will be great buying opportunities. We feel this will be a great buying opportunity because the economy is on the cusp of a growth recovery. And the corporate sector is on the cusp of an earnings recovery. And when earnings recover, naturally the market will do well. The market will climb all the walls of worry. Therefore, investors should seize the coming investment opportunity. Let us get the issue in proper perspective. This year began with big downturns in the market in January and February. All the emerging markets were impacted. The emerging markets were impacted by three major headwinds. The IMF called it the triple punch. Which are these triple punches? What were these headwinds which impacted the market? The first was the fear of the Chinese slowdown. The fear that the Chinese slowdown can lead to a global recession, impacting markets worldwide. The second fear was that the commodity crash, particularly the crude crash, will have spillover effects which will impact commodity exporters, which will impact international trade and the global economy also. The third major punch was that the coming Fed tightening, the tightening of interest rates, the raising of interest rates by the American Central Bank, the Federal Reserve, can lead to a flight of capital from emerging markets like India, and this will impact the markets. These were the three headwinds which impacted the markets in January and February. On the 29th of February, on the budget day, the Nifty touched 6,286 intraday. So that was the time of big bearishness in the market. Let me explain these three major headwinds which the market faced in early 2016. It will enable the investors to get a proper perspective of the economic scenario, the global economic scenario. The fear was that the Chinese economic slowdown will lead to a global recession. The reason is China is now 11.4 trillion economy, and China's share in global GDP is now 13.3%, and China's share in international trade is 14.3%. China contributed 33% to global growth in the last decade. In other words, China became the engine of global growth. China contributed 50% to the incremental demand for metals. So this commodity super cycle that we had from 2002 to 2008 was mainly a super cycle caused by the Chinese phenomenal growth. Then what happened was the Chinese growth slowed down from 10% to around 6.5%. And China, being the largest exporter in the world and largest trading partner to many countries in the world, many fund managers and economists thought that this Chinese slowdown will lead to a global recession. This was the first major headwind which emerging markets in general and the global markets the emerging markets in particular and the global markets in general faced in early 2016. I would say there are two scenarios emerging. The base case scenario is that China will slow down to around 6.5% this year, 6% next year. As per the government claims, China will succeed in rebalancing the economy from a investment-driven economy to a consumption-driven economy. China will succeed in stabilizing its currency. It has already linked its currency to a 13-basket currency as a preparatory step for inclusion into the SDR basket of major currencies, which IMF recognizes for linking the value of the SDR, special drawing rights. And the general assumption right now is the growing US economy, US economy is growing now at a respectable level, not at a strong level, but a respectable level. And this US growth can absorb the mild shock of the Chinese slowdown. That is the base case scenario. I would put a 75% probability to this scenario. But there is a pessimistic scenario which cannot be ruled out. I would personally put a 20% or so probability to that. And that probability is that China slows down sharply, not to 6.5% or 6%, but to 5% or less. Such a sharp slowdown will necessitate a yuan devaluation by China. China will be forced to devalue her currency very sharply in order to stimulate the exports and stimulate the economic growth. But this kind of a sharp devaluation in China will lead to a currency war, because other emerging markets will also have to follow suit. And this will impact the commodity exporters in a big way, because there will be further commodity crash that will further aggravate the problem, and there will be a negative impact on international trade and global growth. If this happens, it will be bad for global markets, for emerging markets, for the Indian markets also. But the probability is, as I said, around 20%. It's a low probability scenario. The second major headwind which the markets experienced in January, February 2016 was that the commodity crash, the fear was that the commodity crash, particularly the crude crash, will have spillover effects that will impact the global economy, because the crude crashed from $118 in May 2014 to $26 in early 2016. So all the commodity exporters, including West Asian countries, Brazil, Russia, landed themselves in deep trouble. They are still in deep trouble. So the spillover effects, many feared, will impact global trade, global exports and imports, and the global economy. And this will further aggravate the flight of capital from emerging markets, because the sovereign wealth funds were selling in emerging markets. This was the major second headwind or major blow which emerging markets faced. But it had a positive impact as far as the Indian economy is concerned, because for India being a commodity importer, this crash in the price of commodities have done a world of good to the Indian macro situation. Our trade deficit has declined, current account deficit has declined, it has helped in reducing the fiscal deficit, therefore inflation is under control. Our macro economy is in a sweet spot mainly because of this. I will come to that later. The third major headwind which emerging markets faced in early 2016 was the fear of the tightening of interest rates, or the normalization of interest rates in the US. When the Federal Reserve System increased the interest rates in December 2015, the consensus was that the Fed will raise interest rates by at least 4 times in 2016, and this can lead to a flight of capital from emerging markets. US economy was coming back to growth, and US unemployment had declined to 4.9%, and anticipating Fed tightening, normalization of interest rates, FIIs had sold $18 billion in emerging markets in 2015. So it was feared that this emerging market selling by FIIs will continue in 2016 also, impacting the markets. These three headwinds, these three important fears impacted emerging markets, including India, in January and February of this year. Now, what is the present scenario? The present scenario is that China is stabilizing. The fear of a sharp slowdown in China is not there now. There is a general consensus that China will succeed in soft landing its economy and stabilizing its currency. And crude, from the low of $26 a barrel, Brent crude, has recovered almost by 90% to $50 as I speak today. Therefore, the devastating spillover effects of the crude crash, which many feared in January, February 2016, will not be there. And the Federal Reserve System chief, Janet Yellen, has gone on record that the Fed will be proceeding cautiously. That means the Fed will not be increasing interest rates sharply. The interest rate hike will not be a sharp lift off. It will be a slow crawl, maybe 2 hikes this year maximum. And therefore the 3 headwinds which the emerging markets faced in early 2016, Jan Feb 2016, are not there right now. This triple punch has weakened substantially. Coming to India, the Indian macros are in a very sweet spot. While addressing the Emerging Asia Summit, the IMF chief Christine Lagarde said India is a shining spot in the gloomy global economy. There is a consensus on that right now. Look at the scenario in India right now and contrast it with the macro scenario in 2013, when we had this taper tantrums and the flight of capital from India. In 2013, we had high twin deficits, that is, high fiscal deficit and high current account deficit, high inflation, rising interest rates, and declining growth. In 2016, we have the deficit situation under control, fiscal deficit under control, inflation under control, current account deficit under control, and the RBI cutting interest rates. The Reserve Bank has already cut interest rates 5 times starting early 2015. Therefore, growth has picked up to 7.2% in 2014-15 and 7.6% in financial year 2016, making India the fastest growing economy in the world, fastest growing large economy. So now the consensus is that even if the global economy slides into recession, it will be a shallow and short one. In the low probability event of a global recession happening, assume that it happens, even then it will be slow and short, unlike the Great Recession, the devastating Great Recession of 2008. India, being a commodity importer, will be a major beneficiary, an outlier in emerging markets. India can grow aided by the reforms and also aided by the fiscal stimulus which the government is giving and the monetary stimulus which the central bank RBI is giving. What we need now are reforms like the GST, which hopefully is seeing a light at the end of the tunnel right now. India is on the cusp of an earnings recovery, and therefore the market also is on the cusp of, I believe, a bullish trend. The Nifty has already climbed more than 1,300 points from the February low, and the fiscal stimulus which is provided by the government has succeeded in increasing investment in a big way. That is stimulating the economy. Monetary stimulus is acting with a lag, providing the monetary stimulus with the economy. Now, to understand this bright spot of India in the gloomy global economy, you have to look at the global economic environment. This slide gives you the global economic outlook for 2016, projection for 2016-17, and the actuals achieved in 2015. World economic growth is expected to be 3.2% this year in 2016, and it is expected to accelerate to 3.5% in 2017. Among advanced economies, US will be doing much better than the rest of the advanced economies with 2.4% growth this year. And in emerging economies, the growth rate will be 4.1% this year, accelerating to 4.6% next year. And in emerging economies, contrast the situation in India, the situation in other BRIC countries, Brazil, Russia, China, South Africa. Russia will contract by 1.8% this year, on top of the 3.8% negative growth last year. Brazil's GDP will contract by 3.8% this year, on top of the 3.8% contraction last year. South Africa will be stagnating at 0.6%. China will be decelerating from 6.9 to 6.5%. And India, look at India, India will be the fastest growing large economy with a growth rate of 7.5%. And this is the reason why we say India is on the cusp of a growth recovery. The global economy is in a state of alert, not a state of alarm, as the IMF says. The Eurozone will experience low growth. Japan will continue to struggle. China is decelerating fast, and India is certainly the bright spot. Coming to the Indian economy, coming to the recent trends in Indian economy, the green shoots which we have been talking about for some time are emerging brightly. The green shoots are turning into shrubs now, healthy shrubs. The Q4 results has been much better than expected, but for the public sector banks' performance, the results are much better than expected. The heavy commercial vehicles and medium commercial vehicle sales, which are a leading indicator of economic growth, were up by 11% last year. Passenger sales vehicles were a record of 2.79 million last year. Q4 oil volume growth, not value growth. It is an important indicator, the highest in a decade. Foreign direct investment in calendar 2015 makes India the largest recipient of FDI in emerging markets. Government is providing big boost to infra spending through major construction activity in roads, railways, irrigation canals, and similar infrastructure. There is a consensus that the monsoon will be good this year. This is very important. There is a consensus that it will be good. And the 7th pay commission spending, which will happen this year, will also stimulate economic growth. We believe that the Indian economy will break out from other emerging market peers because the circumstances are now very favorable for India to break out with a stable macro economy, with fundamental macros like fiscal deficit, current account deficit, inflation rate under control. We are rightly placed for a breakout in economic growth. Our growth prospects are much better than China. However, even though the markets we expect will do well, the bull markets are never linear. They will not be very smooth. There will be sharp ups and downs. The destination, we are sure about the destination. 3 years from now, 4 years from now, the markets will give excellent returns, but the journey will not be smooth. It will be very tough. For long-term investors, this slide will remove all doubts about the performance of the stock market, the returns from fixed deposits, and the returns from gold during the last 37 years. The slide is self-explanatory. In 1979, Sensex was at 100. 79 is the base year for Sensex. Assume that an investor invested 100 rupees in Sensex index in 1979. 100 rupees was deposited in fixed deposit in a bank, and 100 rupees was invested in gold. What is the scenario now? As per March 2015 figures, I have taken 5-year intervals here. 100 rupees investment in BSE Sensex would have appreciated 279 times to 27,957. Now the Sensex is around 26,000. So we can say 260 times the Sensex has multiplied. Fixed deposits would have multiplied 22.25 times. 100 rupee fixed deposit would have appreciated to 2,225 rupees. And 100 rupee gold investment would have appreciated 19.67 times the present value of the investment. The value in March 2015 would be 1,987. There's a huge gap between the returns from the stock market and the returns from the other two asset classes, which are popular asset classes as far as Indian general public is concerned. And remember, today investors have an option to invest in the index. They need not pick and choose the stocks. They can invest in the index. They can invest through mutual funds, and mutual fund returns have beaten the stock market indices by a wide margin. Look at these funds which have given fantastic returns, incredible returns to investors during the last 20 years. Funds with a more than 20-year track record. The slide is self-explanatory. 1,000 rupees systematic investment every month in Franklin India Primer, starting from inception in December 1993, would have given the investor 55,92,720 rupees by 1st of May 2016. This is an incredible return of 20.63% average annual return. It is important to note that these are tax-free returns. Similarly, the other funds also. I've just taken a sample of few funds which have a 20-year track record. 1,000 rupees investment in Reliance Growth during the last 21 years would have given the investor by the 1st of May 46 lakhs of rupees. An upper middle class Indian working in a good position in government will not get this kind of returns as his or her retirement benefits. Therefore, the returns from stock market investment, particularly through the mutual fund route, can be incredible in the long run. As far as the Indian economy is concerned, if you look at the history, the post-independent history, some important facts emerge. In 1947, we were an agrarian economy with a very small economy. It was an agrarian economy. And it took 60 years for the Indian economy to touch a GDP growth, a GDP level of $1 trillion. So $1 trillion mark was touched in 2007. But from 2000, India took only 8 years for doubling her GDP from $1 trillion to $2 trillion. So doubling happened in 8 years. The next doubling will happen, in my estimates, by around 2022, next 7 years, maybe 8 years maximum. So that means the economy will be growing by $2 trillion in the next 7 to 8 years. And when the Indian economy grows to $4 trillion in the next 8 years, at a possible $10 trillion by 2030, as per the projections of Niti Aayog in India, then India's market cap by 2022, when the Indian GDP touches $4 trillion, the market cap also can touch $4 trillion. In other words, the wealth created in India during the last 67 years will be doubled in the next 8 years. That means the investment opportunity at the present juncture is a great investment opportunity. The present problem that we are facing are only temporary problems. We will overcome all these problems. Now, retail investors often do not participate in the wealth creation because large number of retail investors invest in low quality stocks. They invest in small caps and mid caps without doing any real fundamental research into that. They go by market gossip and they jump onto the bull bandwagon at the height of the bull market. They fly away from the market when the market is going down. Actually, they should be investing more when the market is bad, when there is bad news. As the saying goes, buy when there is blood on the streets. The best way of investing in small caps and mid caps would be through the mutual fund route. Small caps, mid caps and micro caps have given, the mutual funds have given incredible returns to investors. Because investors, if they invest directly in small caps, micro caps, etc., they don't have the expertise to choose micro caps, small caps, etc. It is also important to understand that out of the 6,000 odd listed companies that we have, 80% of the stocks have not given inflation beating returns. But 20% of the stocks, that is more than 1,000 companies, a wide basket to choose from, have given very good returns. 5% have given excellent returns. Only a minority of investors, retail investors, have the expertise and time to invest directly in the market. Those who have the time and the expertise should do that. They can do that. But those investors who do not have the time and expertise to invest in the market directly should ideally invest in the market through the mutual fund route. And in the mutual fund, the best strategy should be the systematic investment plan, the SIP strategy. Investing in the market for a long period through the ups and downs of the market by investing money systematically, preferably every month. For those who are investing directly in stocks, Of course, there are some sectors which will do well. IT and pharma are two sectors in which India has comparative cost advantages. There will be times when the pharma sector, for example, may not be doing well, like for example now, because of the US FDA concerns, prices have corrected. I personally believe that this will be a good buying opportunity. Because of the long trend of rupee depreciation and the comparative cost advantages that Indian economy has, these two segments will be doing well. The cyclical recovery for the Indian economy will benefit cyclical stocks. In the early cyclicals like autos, white goods, durable goods, etc. will be doing well. Late cyclicals like capital goods will be participating later, but investors with a medium to long-term horizon can think of buying now itself. Private sector banks and non-banking finance companies with the retail focus will do well. Particularly private sector banks with retail focus will do exceedingly well. Public sector banks might look very attractive from the valuation perspective, but then one has to be careful and choose only 2 or 3 the best quality public sector banks in the public sector bank sector. Cement stocks might look very expensive from the valuation perspective, but they are very bright from the medium to long-term perspective of the India growth story. Systematic investment plans in equity diversified funds, balanced funds will be an ideal investment strategy for retail investors, particularly for those who do not have the time and expertise to invest in the stock market directly. Financial history tells us that stocks have outperformed all other asset classes in the long run. This is the global experience. In India also, as I have already explained, stocks have outperformed all other asset classes like gold, bank deposits, etc. by a wide margin. As in the past, the future also will be extremely good. I feel the future will be better than the past. All the best for a very successful investor. Seize this great investment opportunity unfolding before us. Thank you.